Hi there, I'm Sup Day. I'm a chartered accountant and I'm hoping to do some tutorials in financial accounting and reporting, and this might help students who are sitting for accounting examinations. In tutorial 1, we discussed the revenue recognition and measurement principles and the accounting issues arising from the application of those principles. In this tutorial, which is tutorial 2, we're going to look at the accounting for warranties included in sales contracts, the accounting for sales returns, repurchase agreements included in sales contracts, and finally we'll look at principal versus agent considerations in sales contract. Now let's look at the accounting for warranties or guarantees included in sales contracts. Our next topic is looking at accounting for warranties. Retail goods are frequently sold with a warranty or guarantee that they will operate satisfactorily for a specified period of time. There is no extra payment for this guarantee by the customer. IRS 15 specifies there are two basic types of warranties. One is called the assurance type guarantees, and these are the standard basic guarantee that promises the customer that the delivered product is as specified in the contract and will work without defects for a given length of time. These warranties do not give rise to a separate performance obligation, but any product defects are accounted for by a provision for warranty repairs under IAS 37 by the entity. Service type warranties. These are warranties that provide something additional to the statutory assurance, for example, the extended warranty over a longer period of time. These warranties give rise to a separate performance obligation with the customer paying extra for this service. These are following decision tree that could be used to determine whether a warranty is an assurance type warranty or a service type warranty, and as well as the accounting treatment. Now, it's repeating the same thing here. In one side you've got the assurance warranty, and if there are any product defects here, you account for it under IAS 37 by making a provision, whereas in a service warranty this is accounted for as an extra payment, and this is regarded as a separate performance obligation. We'll now look at an example on how we account for warranties. XYZ PLC is a public limited company with a year end of 31st of August 2021. It sells wind turbines as part of a combined contract which includes a standard 2-year warranty term and maintenance service for a 10-year period. The sales price of the combined contract is $3.6 million. In addition, XYZ PLC offers the option of an 8-year extension to the warranty for an additional fee which is paid at the time of the initial sale of $0.8 million. If sold separately, the selling price of the wind turbine would be $3.2 million, and the selling price of the 2-year warranty and the 10-year maintenance service would be $0.9 million. The extended warranty has a separate selling price of $1 million. Required, the directors of XYZ PLC would like to know how the above transaction should be accounted for under IFRS 15. The first step is to identify the performance obligations in the contract and then apportion the contract price to the performance obligation. The combined contract price of $3.6 million includes the standard assurance warranty of 2 years, which do not give rise to a separate performance obligation. The entity can, however, make a provision for possible warranty repairs in the 2-year period under IAS 37 provisions, contingent liabilities and contingent assets. The combined contract with a sale price of 3.6 billion therefore only has two performance obligations, the wind turbine and the maintenance and service contract for a 10-year period. When the combined contract includes the extended warranty, then there are three performance obligations. In the next slide, we will allocate the transaction price to the performance obligation. So now we are going to allocate the transaction price to the performance obligation. We start with a contract with the assurance warranty where there was only two performance obligations. Start with the wind turbines and warranty, which is 3,200, and then come to the maintenance service, and the standalone price is 900 or 900,000, and that gives us a total figure of 4,100. Now the discount is the difference between the total of the standalone price and the contract price, which is 3,600 or 3.6 million. This sum works out at 500 or 500,000. And what we've got to do now is to calculate the percentage that 500 represents of the total of the standalone price, which works out something like 12.2%. Our next task is to allocate the discount to the contract price in standalone prices, and if we take 3,200 and minus 12.2, we get a figure of 2,810. Same with the maintenance service, 900 minus 12.2% gives us 790, and that gives us a total of 3,600, and that is how we allocate the discount to the contract price of 3,600. Our next task is to look at a contract with the extended warranty where there are three performance obligations. So the standalone price for the wind turbines is 3,200, the maintenance service is 900, and the extended warranty, which is 800, 1,000, and that gives us a total figure of 5,100. To work out the discount, we have to work out what the contract price is, assuming that now we have an extended warranty, and that is 3.6 million plus 0.8, and that gives us 4.4 million. So if we take the difference between the two, we get 700,000 expressed as a percentage of 5.1 million gives us a figure of 13.73. We now allocate this discount to the contract price or the standalone price. Minus 3,200 minus 13.73 gives us 2,761. From 900 we take away 13.73 gives us 776, and from 1,000 we take away 13.73%, that gives us 863. And if we total that up, that gives us 4,400, which is the contract price. Next, we look at the accounting for sales returns. A right of return gives a customer certain rights: a full or partial refund of any consideration paid, a credit that can be applied against other amounts owed or that will be owed to the vendor by the customer, finally a different product in exchange, or any combination of the above. How do we account for expected sales returns? All expected sales returns are to be credited to a returns liability account. In current assets, a right to return good valued at the lower of cost and NRV will match the expected returns. This amount is transferred from inventory. After the expiry of the return period, the affected goods amount is transferred to the cost of sales from the right to return goods. And at the same time, the sales value of the goods for which the return period has expired is transferred from the returns liability account to revenue. Here is an example of a company, a PLC company, which sells electrical goods and which has a returns policy, which states it is the group's policy to sell its products to the end customer with a right of return within 100 days. Therefore, returns liability, which is included in accruals, and a right to the return goods included in other current assets are recognized for the products expected to be returned. Now, this is in compliance with IFRS 15. Let's look at an example how we do the accounting entries for expected sales returns. A retailer sells 100 items for £10 with a cost per item of £8, resulting in a margin of £2 per item. It anticipates that 12 of those items will be returned for a cash refund or exchange for a different item. Question: how should it be accounted for in financial statements or under IFRS 15? If we look at the financial statements, in the revenue, we sold 100, there is an expected return of 12 units, so that gives us 88, and we multiply that by £10 per unit to give us 880. The cost of sales will be £88 times the cost of each of those units, which is £8, so it gives us 704. In the balance sheet, the right to return assets will be the 12 expected returns times 8, which is the lower of cost on NRV, to give us 96. And finally, we have refund liability, which will be under current liabilities of 12 of those units times the money that we have received of £10, that gives us £120. Now we'll briefly look at the accounting for repurchase agreements. So what are repurchase agreements? It is a contract in which an entity sells an asset and also promises to repurchase the asset should the customer wish to trade it in at the end of the contract. It's very similar to sales returns, but with a repurchase option exercised at a later date. So look at an example. XYZ PLC enters into a 24-month wireless service contract with customer AB. At contract inception, XYZ PLC transfers to customer AB a handset for £600, together with the right to trade it in at that handset for £100 at the end of the service contract. The standalone selling prices of the handset at contract inception is £600. XYZ PLC expects the handset market value to be £150 in 24 months' time. Required: how should XYZ PLC account for this sales transaction in its accounting records at the date of sale? Right, so the judgment is required here whether the customer will trade in the handset for £100 when the market value is expected to be £150. If it is assumed that the customer will trade in the handset, then there are two performance obligations. One for the sale of the handset and the other for the trade-in. At the date of sale, XYZ PLC will assume that the trade-in will occur in 24 months' time and will therefore set up a contract liability account for the discounted amount, which in 2 years will equal £100. The balance of the transaction price is credited to revenue. We now look at principal versus agent considerations in sales contracts. When another party is involved in providing goods or services to a customer, the entity shall determine whether the nature of its promise is a performance obligation to provide the specified goods or services itself, i.e. the entity is a principal, or to arrange for those goods or services to be provided by the other party. The entity is an agent. Now, if you are the principal of the transaction, you must account for the gross total of revenues received. And if you are an agent, you are required to show only the commission you are entitled to receive. Therefore, the principal or agent question is critical. However, it's not easy to answer. IFRS 15 provides the following criteria to decide if the entity is acting as an agent. Another party has the primary responsibility for providing the goods or service to the customer. The entity does not have the discretion in establishing prices for the goods or services. The entity is not exposed to credit risk on the amount due from the customer. And finally, the entity's consideration is in the form of a commission. Let's look at an example as to whether the entity is acting as an agent or principal. An entity runs a website which enables customers to buy goods from a range of suppliers. Prices are set by suppliers, but payments are processed through the entity's website. Customers pay in advance and any goods delivered directly from the supplier, and goods are delivered directly from the supplier to the customer. The entity receives a commission of 10% of the sales price and has no further obligation to the customer after arranging for the products to be shipped. So the question is the entity acting as an agent or principal? So the solution is the entity is acting as an agent based on the following points. Goods travel directly from the supplier to the customer so that the entity never has physical custody of them and does not bear the associated risk. The supplier, not the entity, has the obligation to the customer. The entity does not set prices or bear credit risk, and the payment received by the entity is in the form of a commission, so the entity should only recognize as revenue the commission received from the supplier.